afternoon, evening to everyone joining us today. My name is Kaleem Aslam, and I am the chairman of the UK Ireland chapter of ICAP members. On behalf of the UK Ireland chapter, I would like to extend a heartfelt welcome to all our distinguished guests, members, finance professionals, and students attending today's webinar, Basel 3.1 Decoded, a practical guide to PS1/26 for banking professionals. This session marks the third and final episode of our webinar series on PRA regulations and reporting requirements for banks, and we are delighted to see such strong participation in this concluding session. The UK Ireland chapter has previously organized a number of successful webinars on important topics such as mastering communication skills and FRS 102 updates, which were generally appreciated by our esteemed members. More recently, we also delivered an insightful session on transfer pricing for finance professionals, reflecting our commitment to covering a diverse range of professional topics. We are delighted to see such strong interest in today's session, focusing on a highly relevant and evolving area of banking regulation. As regulatory expectations continue to evolve and the financial landscape becomes increasingly complex, Basel 3.1 has become a critical area for banking professionals. Understanding its practical implications, regulatory expectations, and implementation challenges is now more important than ever. Today's session will provide valuable insights into Basel 3.1 reforms, regulatory reporting, and key practical considerations for finance, risk, and compliance professionals. We are also pleased to share that this webinar carries 2 hours of CPD credit, supporting your continuous professional development. Before we proceed to the technical session, it is my pleasure to introduce and invite our esteemed guest speaker, Mr. Yasir Gadit Abdul Rahman, Council member and the chairman of the Overseas Coordination Committee of Institute of Chartered Accountants of Pakistan. Yasir is a fellow chartered accountant with over 20 years of professional experience in audit, taxation, corporate finance, and management consulting. Yasir, we are honored to have you with us today. I would now like to invite you to share a few words with our members. Thank you.
Assalamu alaikum, Kaleem, Afsha, Wakar, and all the participants. Good afternoon, and I welcome you on behalf of the chapter and the OCC on this insightful session. But before I begin, I would like to sincerely thank Kaleem, the entire managing committee, for organizing this wonderful webinar series. And my appreciation goes to the entire team that works behind the session, including Afsha from ICAP. So much appreciated. And on behalf of the chapter and OCC, I would like to thank and welcome Wakar Aslam for his vast experience in banking sector and then bringing that for the members of the institute. So thank you very much, Wakar, for that. Now we all know that banking and financial sector is changing very, very quickly, and regulations continue to evolve in the professionals. So we must keep learning to stay relevant. At the same time, webinars like these help us understand not just the rules, but also how we apply in practice. Now, on behalf of the Overseas Coordination Committee of ICAB as the chairman, I'm proud to see the overseas chapters taking all the bringing such learning opportunities to the members. And I promise that we will continue to do that in the future as well. But before I conclude, I would really want to say that the OCC is taking all those initiatives, and we will continue to take all those initiatives of bringing different type of members engagement initiative, including the sessions, webinars, um, so that our members feel more connected than ever. And so that's our game plan. So we'll be putting our members first as an initiative. Over and above, I would like that since we've got an opportunity that we've got a speaker like Wakar Aslam with us, so I would encourage all the participants to make the most of it by being connected, by asking relevant questions. And again, I will conclude by saying thank you to the organizing team and Kaleem. Looking forward to an insightful session. Thank you. Kaleem, I think you're on mute.
Thank you very much, Yasir, for your inspiring and thoughtful remarks and taking the time for us today. Uh, Your insights and continued support for the global ICAP community are truly appreciated, and we are grateful for your encouragement and guidance. It is now my pleasure and privilege to introduce our session trainer, Mr. Wakar Aslam. Wakar is a highly experienced finance and prudential regulations audit SME with over 2 decades of experience in London's financial sector. He specializes in regulatory reporting, internal audit, and prudential assurance, and is well known for delivering clear, practical, and actionable insights. With his extensive industry experience and deep understanding of regulatory frameworks, we are confident that today's session will be highly insightful and beneficial for all participants. Vakar, thank you for joining us today. We are honored to have you with us. Without further delay, I would now like to hand over to Vakar to begin the session. Mr. Vakar, over to you. Thank you.
Assalamu alaikum, everyone. Good afternoon. Thank you much for joining me for this session. I really appreciate Kaleem and ICAP committee for organizing this webinar series, and also appreciate Yasir for joining us today and for his kind words. I'll share my screen now and we'll make a start. Okay, can you see my screen now? All right. So we are working, we're going through the Basel 3.1 regulations, which are going to be implemented by PRA from 1st January 2027. Just before I make a start on this one, so this is purely a knowledge sharing session. It's not advisory, it's not consulting. So it's purely knowledge sharing session, which we are doing today. So these rules are a major change in regulations almost a decade, and they are bringing key changes in the regulations in the capital requirements area. Uh, these rules were published by PRA in January 2026, and they are effective from 1st January 2027. There will be a transition period of 3 years when the rules become fully binding. So these rules are applicable for banks, building societies, and so on. So we'll be focusing purely today from the banking perspective. The instrument by which these rules were published is called Policy Statement 1 by 26. Okay. So in our first two sessions, we have looked at the capital resources and the credit risk capital requirements. Today, we will key focus areas counterparty credit risk, large exposure, and operational risk, plus the the how it impacts the model of the banking area. But before we go into that one, I would like to have a recap. So there might be new attendees today, so who haven't looked at the capital resources and credit risk capital requirement. So in order to make sense of everything, it would be important. So we give a recap for a few minutes, and then we go into more complex areas. So, so we're starting with the capital resources. Actually, the three pillars which we have. Just let me adjust my screen. Okay, so Basel framework has three pillars. The first pillar is the minimum capital requirement, and second is the supervisory element where the regulator reviews, and the third is the market discipline. So the way three pillar works together is pillar one is the minimum capital requirement. This is based on the prescribed regulations, uh, and then it is there to cater for the risk which a business is exposed to, which is the credit risk, market operational risk, and so on. And as a result of it, for these risks, minimum capital requirement is computed based on the risk-weighted assets, and the minimum requirement is 8%. So that is the minimum capital a business is required to hold for the risk the business is exposed to. On top of that, the regulator, which is PRA in this case, the Prudential Regulation Authority in the UK, they perform supervisory reviews, and they would require a business to hold additional capital on top of the Pillar 1 requirement if the business has additional risks. For example, interest rate risk in the banking book, model risk, and so on, which are not covered by the Pillar 1 requirements. So that is the second pillar. And the third pillar is the market discipline, by which the banks are required to provide information to general public, the investors, by publishing these documents on a quarterly basis and annual basis, which provide the information on the risk management framework of the business, the capital structure, risk management strategy, and so on. And it provides information on the RWA's capital ratios and other key elements related to the risks. So this is the high-level three pillars around which the regulations are structured and the reporting requirements are structured for the banks. So we look at, so in a balance sheet, you have assets, you have liabilities, and you have equities. So how does the regulation work in this scheme? So when a business takes on risks, it issues loans, it issues, it makes investments, it taking a risk as a result of it. So if a business is issuing loans, it is going into the banking book, it is coming with the credit risk. If the business is taking derivatives or investment products, it is resulting into the market risk. So for these risks, the business is required to hold the capital in order to mitigate these risks. And the capital sits into the equity and regulatory capital bucket. So there's a slight difference between the IFRS regulatory requirements versus the requirements under the Basel III. There are specific definitions which derive how the capital is structured. So based on the risk which the business is exposed to, the business is required to hold capital in order to mitigate those risks. The way these capital instruments are being held are there's specific capital classifications split between common equity tier 1 capital, additional tier 1, tier 2, and so on. So these are the different type of instruments by which a business holds capital, and they have different purposes and uses. And as we discussed, the minimum capital requirement is 8% of the risk-weighted assets. So I will leave every slide here for a few seconds before I move to the next slide. So for everyone's purpose. Okay. So now we look at the tier 1 capital. Tier 1 capital is composed of two tiers. One is a common equity tier 1 capital, and second is the additional tier 1 capital. Common equity tier 1 capital is the capital which is used in the going concern by the business, which is composed of the common shares, retained earnings, and the comprehensive income. These are the things which you see as part of the equity under the IFRS financial statements. So, and additional tier 1 capital is other type of instruments which are preference shares, contingent convertibles, and so on. Uh, they rank below CET1 instruments, and there are certain characteristics which are required to be met for instruments to be classified as common equity tier 1 and additional tier 1 instruments. They are perpetual in nature, they don't have any maturity. They are going concern, i.e., they will absorb losses while the business is not insolvent, and they have a discretionary coupon. You don't need to issue dividends every year uh, unless you have profits, and then they are subordinated and they loss absorbency during the going concern. Yeah. So these are specific characteristics of the tier 1 capital instruments. As per the regulations, under the PS1 by 26, Article 92, uh, the common equity tier 1 capital is 4.5% of the risk-weighted assets, and additional tier 1 is required to be 1.5%, and the tier 2 capital is supposed to be 2% of the risk-weighted assets, which brings the total to 8%. Tier 2 capital is a capital which absorbs losses in the gone concern. So that is a clear distinction between the tier 1 capital and the tier 2 capital. So tier 2 is going concern capital, which will absorb losses like retained earnings. If you have losses, the retained earning goes down straight away. That's how it is absorbing losses. And so, for the subordinated loans, which sit under the tier 2, they will only absorb losses when the business is insolvent. They can be written down depending on the conditions which those loans have. Okay. So now we look at the total regulatory capital stack. We have seen the 4.5% before. We looked at the additional tier 1 as well, and we looked at the tier 2 as well, which brings us to 8% capital requirement, which we saw before. So the question is this 8% capital requirement, is this a scientific number or calculated by uh, any sort of a model? The answer is no. It is a number which is developed by the regulators, considering this much can absorb the losses and the business can continue with this much amount of capital. But looking at these stresses which we saw in the market over the years, the regulators went on to identify a number of buffers which could support the business in the stress scenarios. So they have added a capital conservation buffer, which is a standard percentage of 2.5% of risk-weighted assets, which is need to be maintained based using the capital CET1 instruments. Similarly, there's a counter-cyclical buffer as well, which is required to be maintained from 0 to 2.5% based on the exposures of the company within different markets. And then for the global systematic institutions, there is an additional requirement which is prescribed by the regulator, which ranges from 1 to 2.5%. So there are additional buffers which have been required to be held on top of the 8% minimum capital requirement in the form of these buffers. So we see the total CET1 then ranges from 7 to 12%, with an additional Tier 1 ranges from 8.5 to 13.5%, and the total regulatory capital then goes up from 10.5 to 15.5%, rather than the 8% which we spoke about before. Okay. On top of the regulation which we see in the CRR regulation, there is an additional requirement by the Financial Policy Committee of the Bank of England, and they have required the banks to hold a capital of 13% as a minimum now, and 11% of that should be CET1 capital. So we have the regulations with the specific brackets between CET1 buffers and so on. But the Financial Policy Committee decided that they need an overall umbrella percentage as well, which is 13% of for the total capital, and underneath that the CET1 should be 11% of that. So now this FPC requirement becomes a binding, and the banks are required to hold at least 11% in the CET1 capital. Okay. Okay. So I've been speaking for a few minutes. I'll just ask some questions at this stage. Uh, Kalim, would you be able to read the question on my screen?
Yes.
So,
What are the three pillars of the Basel framework and what does each cover?
so if participants could reply in the chat, and we'll look at the response, and we'll give a minute before we do that, please. Okay. Do we have any responses in the chat, please?
Not yet. Yeah. One is minimum capital requirement, governance and market. Then one of the participants has mentioned supervisory control, credit and review, market discipline.
We'll
Mr.
give
Sheikh
5 more
Mohammed has
seconds.
mentioned minimum capital requirements, market requirements, and supervisory review level requirements.
Okay, thank you much for this, everyone. And let's look at the answers now. So as we discussed in the slide earlier, the answer would be the pillar one requirements, pillar two, and pillar three. Pillar one is the minimum capital requirements, which is the under the regulation for the key risk which the business is exposed to. And the pillar two is the supervisory review, where you get the pillar 2A add-on and the PRA buffers as well. And then we have the pillar three, which is the market discipline, the public disclosures on risk exposures, capital structure, and leverage ratio, and so on. Question number two, please. If you could have a read of it, please. So we'll give 30 seconds to everyone to read this one and give us a response. Okay, so have you got any response on what is the minimum CET1 ratio?
8%, 8%, and 11%.
Okay, so under the minimum ratio prescribed by Article 92 is 4.5%, and then the capital conservation buffer on top of that is 2.5%. Uh, the If we look at the Financial Policy Committee, the guidance, that ratio is 11%. Yeah. So we go with the Basel 3.1 regulations under the PRA rule book, and that prescribes a 4.5% ratio. But the overall ratio given by the Financial Policy Committee, which becomes binding, is 11%. Okay. So these rules are complex and they evolve slowly. So we see a lot of changes across, and then they all work together to provide us the big picture. Okay. One of the key changes which are brought in by Basel 3.1 regulations, which are currently not effective from 1st January 2027, are an output flow. Banks have a number of models which they use, and those models are able to generate the risk-weighted assets, which are below the risk-weighted assets produced by the standardized approaches. So it means the banks which have complex models, big models, if they have put the required infrastructure in place, they can gain a benefit of the risk-weighted assets, which might be higher than which other can take, which don't have these models. Some of these models are complex and the risk weight produces too conservative. So in order to reduce this conservatism and in order to effectively have a level playing field across the market, PRA has introduced an output floor which effectively restricts the benefit which the banks gain from these models. So in this one, we have a total risk-weighted exposure amount under the floor, which should be maximum of unfloored total risk-weighted exposure amount multiplied by the standardized total risk-weighted exposure amount plus the OF adjustment. It means whatever you have under your advanced model RWA computation, you have to recompute the RWA under the standardized approach, and you have to use these percentages based on the year which you are in currently, and then add the OF adjustment. And the higher of the two, either the advanced approach or computed with the standardized approach, that is going to be the binding requirement. So even if you have models and you have computed a lower risk weighted requirements, you have to recompute it under the standardized approach, and that would effectively determine the final RWA which a bank is required to maintain. So this requirement becomes binding for many banks across the industry across the years because their RWA produced by the models is fairly low. And if they compute it under the standardized approach and put it this multiplied with these floors amounts over across the years, uh, that standardized approach is higher than what they have produced with the modeled approach. So this requirement is a major change under the Basel 3.1 regulations, and it is bringing more level playing field across the market. So I'll leave this screen here for a moment. Every bank will need to produce this one. They need to assess it in their capital planning, in their ICAP processes that needs to be considered under the stress testing and everywhere. So this is a very, very material change, which the banks are required to comply with from 1st of January. It will be gradually implemented with a higher rate from 2027, uh, and then the final will be 72.5% in 2030. Uh, So, okay, so I have a question on this slide. So, Kim, if you could kindly read this one, please. I'll read the question. What is the purpose of the output floor under PS1 by 26, and at what percentage is it fully phased in? So, if you could provide some answer in chat in very simple words, I really appreciate it. Kiran, do you have any answers? Right. So let's look at the answer which we have. So the output floor prevents internal models from falling too far below the standardized approach. It is fully phased in across the years, and the final phased in requirement is 72.5%. So the objective is to not have the businesses which can have used model approaches come with a very low requirement, and while if the same risk is with the other banks that using the standardized approach, the charge would be much higher. So the objective is to have a level playing field across the industry. Okay, so this is a little bit difficult questions. If you could have a read of it and try to answer it, if possible. William, do you have any response? William, are you in mute? Okay, let me answer it for you. So UTRE is the unfloored total risk exposure amount, which is the final value, which will be binding. And the unfloored total risk exposure amount, calculated using the internal models such as IRM and so on. And STRE is the standardized approach. So you have your models as the unfloored value, and then you have your standardized number, and then you have your output floors as a multiplier, and then this is the off adjustment related to the own funds to avoid double capital impact due to the IRB versus the standardized. So these are the key attributes which you need to use in order to compute the output floor. So output floor, as I emphasized earlier, is a binding requirement, and banks are worried about it because the benefit of the model which they are using, the millions they are spending using the models, are impacted as a result of this output flow. Okay, so we had a little bit of a recap on the capital resources side. Now let's dive into the capital requirement side. And in order to look at the capital requirement side, we know we just start to identify why these regulations were needed. Yeah. So the first thing which these regulations are trying to address is the excess variability in the risk-weighted assets. Uh, it was studied by Basel Committee that the same exposures used by the different banks, there's a 20% variability with the banks who are using the models. And so, in order to address that, they have brought in more risk sensitive standardized approaches, and they have updated, they brought in a more level playing field. So the banks can come up with a similar capital requirement for the similar risk weighted exposure amounts. Loss of comparability across the industry. If the banks were using more complex model, there was a loss of comparability based on the model which were being used. The capital optimization problem. The banks had incentive to build models that minimize the capital buffer rather than accurately measure the risk. So the whole objective is to have enough capital. If the risk materialize, the bank can survive those risks. But by using those complex models, the risk weight computed was too low. Hence, these new regulations were introduced. And obviously, the lessons from 2007 2009 financial crisis. So if we just try to simplify it, the whole purpose is to make the standardized approach more risk sensitive, and then to limit the use of models the way were being used before, and by use of the output flow, provide an output floor so the banks can have a similar consistent risk-weighted assets, and the risks can be managed in a more prudent way. So that is the purpose of the Basel 3.1 regulations. All right. So on this slide, we will look at a little bit more detail on the various risks which we have under the pillar one. We mentioned earlier, we have the credit risk, market risk, CVA operation risk under the pillar one. The credit risk arises on your banking book activity. You have loans, credit cards, all these give rise to credit risk. And in order to manage the credit risk, you have a standardized approach, or if you're a smaller bank, there's a simplified standardized approach available as well. And then there's an IRV approach, which is the model approach. Then if you have securitization products, there are specific approaches to use, which are used to compute the securitization capital requirement. And then for the complex product like derivatives and security financing transactions, there's a counterparty credit risk capital charge. And then settlement risk arises as well for the traded products. The standardized approach, the exposure need to be divided in number of exposure classes, as we see in the left column. And then for all of these exposure classes, there are specific regulations in order to compute the risk weight around those classes. So market risk arises on the trading activity. If you have any, say, equity positions, if you have interest rate risk in the trading book, that gives rise to the market risk. So under the simplified approach, you have your interest rate risk in the trading book. You have FX risk, equity, commodity, and option risk. And for all of these, we have to compute the market risk using specified regulations. Uh, Under Basel 3.1, there is a new standardized approach, which is a lot more risk sensitive. And it has new variables called delta, vega, and curvature, and default risk charge and residual risk add-on. So although it is a standardized approach, but it is a lot more complex than the previous approach, which is currently being used and applicable until 31st December 2026. So banks are required to update their business requirement documents and their regulatory reporting engines, and obviously the data mapping, the data lineage, and so on, in order to implement this new approach. And obviously, it results into relatively higher capital requirements, and it is a lot more risk sensitive as opposed to the simpler approach, which is currently applicable. And then we have the IMA approach, internal model approach. For IMAs, for anything to do with the models, you have to have these models submitted to the PRA. PRA gives you permission to use those models for specific type of exposures. So, and then there's ongoing model monitoring and model validation requirements, and obviously the internal audit requirements as well for model validation, model reviews. So, Basel 3.1 IMA approach is going to be implemented from 1st of January 2028. So there's a slight disconnect here. So everything else we see on this slide is going to be implemented from 1st of January 2027, except the IMA approach, which is delayed until 1st of January 2028. Another complex area is the CVA risk, which is credit valuation adjustment. This arises on the OTC derivatives and SFTs. And for these one, there are two new methodologies which have been introduced. One is a basic approach for the CVA computation, and second is the standardized approach, which is more sophisticated and risk sensitive. So this is a new challenge for the banks as well, and to implement this CVA risk chart. Operation risk has materially changed under the current regulation under Basel III. There are the standardized approach and the model approach as well, and basic indicator approach available. But going forward, we have the standardized measurement approach only. So all these approaches have been removed, and only one standardized approach has been introduced, which has the BI component and the internal loss multiplier, which provide you the operational risk capital requirement RWAs, which is required to be retained. And then the output flow, which we have spoken about just now. So under the pillar one, you have your credit risk for your lending activities, say you have market risk for your trading activities, you have CVA for your derivatives and for your repo reverse repo activities, and operational risk is applicable across your business. So you have your interest, these and components, your service component, your financial component. For all of these components, there are detailed formulas available in order to produce the operational risk requirements. Okay, and then all of that is then considered against the output flow and comparing the output of RWA under the models versus what is under the standardized approach, and using a multiplier based on the year we are in. and plus the OF adjustment gives you the binding requirements under the output flow. Okay. Okay. So it is fairly hot here. So before we move to the next one, I would like to have a 2 minutes break. I think it's quite a hot weather today.
We may join after 2 minutes. Thank you.
Hi everyone, we can make a start now. Okay, so now we look at the credit risk, and under the credit risk, there are two approaches: the standardized approach and the model approach. So let's look at the standardized approach first. Uh, Under the standardized approach, this is the approach which every bank can use as a main key approach, which is available under the PRA regulations. Uh, and the risk weights are computed in this approach using different classifications, which the exposure is classified into. And the next element, the next attribute is the external rating, and those external ratings are used to map into specific credit quality steps. And then based on those buckets, the RWA is computed. Uh, Apologies, just one second. Okay, so we'll continue with the standardized approach. So under the standardized approach, there are a number of key attributes. One is the external credit rating, the correct classification of exposure under different classifications, and the external credit rating helps you determine the relevant credit quality step, and that effectively leads us to the RW computation. The RW formula on this box here is the exposure into the relevant risk weight. For the corporate exposures, if there's a loan which is AAA rated, so this is the element where the external rating comes into play. You have to map it into the correct sequence, which is sequence one in this case. And the standardized risk weight provided is a 20% risk weight amount. If the loan is fully drawn and the loan value is 10 million, the RW will be a simple multiple of the exposure amount into the RW percentage, and 8% of that will be considered as the capital requirements. So if we have a standardized exposures approach, it is fairly easy. So you have to simply correctly classify the exposure, look at the external credit rating, and then you have to proceed with the correct credit quality step. And based on the rating, the RW percentage provided, you compute the RWA and you compute capital requirement at 8% of the RWA. So under the standardized world, it is fairly easy. Uh, the new requirement which is introduced under Basel 3.1, which is currently not in force, is the due diligence requirements. So every bank which is applying the standardized approach will have to use the due diligence to assess whether the external rating given actually justifies the risk which the bank is exposed to. And if the bank assesses that the risk weighting should be higher, then the bank will take it, say, in this example, from CQS 1 to CQS 2, and the risk weight percentage, say, will change to 50% for the same exposure. So that is a mandatory requirement. You have to have a framework around due diligence, and you have to have evidence that for these exposures, you are considering the due diligence requirements, and these are applied on a regular basis. Uh, okay, so that is the high level view of the standardized approach. Mm. Okay, in order to classify the exposures under the standardized approach, you have to have a certain uh, data attributes which you need to consider in order to classify the exposures. The key attribute is international standard ISIC classification. So ISIC, by using ISIC classification, you classify exposures between different categories like financial institutions, corporates, and so on. And that determines effectively the classification which we see under the standardized approach. So this is a very, very key attribute in order to correctly classify the exposures. Legal entity identifier is a identifier which is applicable to any entity, and these have to be obtained by the legal entity itself. uh, they help identify a specific area within the regulation called the large exposure requirements. When we reach to large exposure requirements, you will be able to make a connection with this one. So every entity needs to have identifier because two entities can have very similar names. Names could be written incorrectly, or maybe some in one system you have full name, in other system you might have a smaller name written in there uh, by any person in there. But legal entity identifier will prevent any errors due to this one. Otherwise, if the names are not consistent across the systems, you end up having maybe same entity might be classified differently, and same entity might be occurring different risk weights. So this ensures that the exposures to one entity are identified and clubbed together, and one risk weight is applicable to that entity. SME classification, that is a classification which is extremely important for under the current regime because you have a beneficial risk weight for the SMEs. Uh, but going forward, that risk weight will be removed under Pillar 1, but under the Pillar 2 approach, that benefit can still be applied. But still, under the SME classification is really important because under the corporate, there is a specific approach which you can use for the SME exposures. So from practical perspective, when the bank is setting up its system, the data mapping, these three attributes are really important in order to correctly classify the exposure and to compute the risk-weighted requirements. All right. So we have a question on the screen. If you can, sorry. Okay, so today's workshop, I have questions more in a theoretical form rather than multiple choice answers. So please try to provide the best possible answer you can, and then we can look at the answer provided. Nilim, do we have any answers?
Not yet. I think it would be best if you can give some hints or something like that.
Okay, so we're just looking at the standardized approach. It is a binding approach under the PRA regulations. If you could just try to explain it in your words how this approach works and who can use it. I understand this is a slightly different, difficult way of Q&A, but yeah. In the interest of time, I'm open to answer here. So the standardized approach using externally determined risk weights. It is a default approach which all banks, building societies, and peer designated firms are allowed to use. And the exposures are classified under different classifications like central comments, institutions, corporate, and so on. Yeah, and then the risk weight is computed using a number of articles as we have in the. So I would really appreciate if you could try to provide some answers. So if somebody attended the previous webinars, they should be able to answer this question as well fairly easily. What risk weight applies to UK government Bank of England exposures? Hint is that these are the least risky exposures because people expect that the Bank of England will not go bankrupt and the money will definitely come back. So considering that, could you suggest is it 20%, 50%, 100%, or 0%? Do we have any answers? Hey, Kalim, is there anything? Okay. Um, so the risk weight is 0%. As I mentioned, it is the least risky exposures. So the 0% risk weight applies to the Bank of England and UK government exposures. So I would really appreciate, guys, if you could respond. This is a learning session, is a training. So let's learn from each other. Let's give some response to these questions, please. Next, we're looking at the IRB approach. This is the internal rating based approach. This is a complex approach. In order to use this approach, banks have to get model permission. And based on those model permissions, banks can use the internal rating based approach for specific exposure classes. So the permission could be, say, it is for retail, but it is for retail exposures in Europe only. It is not allowed for retail exposures in Asia or Africa, or it could be that exposure is available for corporate exposures only, and so on. So it could be based on country, it could be based on exposure class. Um, these waivers are binding, so if there is any non-compliance with the waiver, it is a breach of requirements, and that can put the bank in big trouble. In order to have the IRB approach, the bank need to have the model. The model go to PRA, they get approved, and then there is internal risk management system, which is the model validation, model monitoring on a going concern basis, and the internal audit requirements on annual basis as well. So we look at the foundation IRB approach. Under the foundation IRB approach, there's only one variable, which is the PD, which bank can estimate based on the model. But other two attributes, which is the LGD and EAD, they are prescribed by the rules themselves. So this approach is available for central government and central bank, the institutions, and the corporates. Uh, And the LGD floor applies under the PS 1 by 26, and this approach is not available for the retail exposure specifically. So I would refocus that. I think this approach is available for the institutions and the corporates. Retailers are specifically excluded to use this approach, and there's only one type of attribute under this approach which can be modeled. The other two attributes are based on the regulation. Under the advanced IRB approach, all the three attributes, which is the PD, LGD, and EAD, they can be modeled. This is available for retail exposures, which is mandatory, and then it is available for the qualifying corporate exposures as well. There are new PD floors and LGD and EAD floors have been introduced under the PS1 requirements in order to make sure that the floors computed by the system are not too low. And the models are required to hold a number of years of data in order to be eligible to compute these requirements. Okay. And for sovereigns and equities, the SA is the only allowed approach. And for the large corporates as well, they are allowed to use the foundation IRB only. They are not allowed to use the advanced IRB approach. And the SME concept, which we studied a moment ago, the corporates which are SME, they are allowed to use the advanced IRB approach. So the key change under the Basel 3.1 regulation is that certain classifications have been restricted from using the IRB approach or the advanced IRB approach. Uh, there's a third approach called slotting, and that is available for specific type of exposures only, which are project finance, object finance, commodities finance, and so on. So IRB foundation could be used for your cards, mortgages, and so on. Advanced IRB similarly. Uh, and slotting is only for specific project finance and so for different type of exposures. Okay. So this table here provides us a view of which exposures are allowed to use which approach. So sovereign central banks, they're allowed to use a standardized approach only. Institutions have been restricted to use foundation IRB approach only. So currently under Basel 3, banks use the advanced IRB approach, and obviously the risk of default is very low for financial institutions. Hence, the advanced IRB approach produces very low risk weight assets. Going forward, they will have to use the foundation IRB approach, which means they will be exposed to LGD and EAD floors from the regulator, resulting into higher IRB requirements. Okay, and obviously the standardized approach is always available. Uh, for the corporate specialized lending, it is slotting approach only, and then we can see different corporate exposures. There are different approaches which are being prescribed. Corporate SMEs can continue to use the advanced IRB approach. Retail exposures are allowed under the advanced IRB approach only, and there are certain exposure types which are currently allowed under the Basel 3.1 IRB approach. They are not going to be allowed under the Basel 3.1 world, like equities and the securitization position. They will go under the standardized approach only. So the restrictions on use of the models is quite key, and the banks, as a result, banks had to update their models for Basel 3.1, get a reapproval from the PRA on those models, uh, and in order to continue them under the Basel 3.1 world. And certain exposures like equities, they will be reclassified from IRB to standardized. As a result, they will be exposed to a much higher RWAs in the capital requirements. We looked at the key parameters briefly: PD, LGD, and EAD, and maturity. So here we defined those in a little bit more detail. So PD is the probability that an obligor will default within a year horizon. And there are floors introduced under the Basel 3.1 regulation for different exposure classes, which are listed here. Loss given default uh, is a proportion of EAD lost if the obligor defaults. If the obligor defaults, so this is the exposure which will occur at that time, net of recoveries and any cost. And again, we see the floors which are available, minimum floors for residential mortgages and so on. Expected gross exposure at the moment of default uh, is called the EAD, and the maturity is also required to be computed. For retail, the maturity uh, the M does not apply to the retail exposure. It is taken as 1 year, and it is mainly applicable to the corporate exposures. So these are the attributes which are produced by the model, and from there they feed into the regulatory reporting engines, and those engines produce the risk-weighted assets using these attributes. Okay, so here we have the capital requirement formula. Uh, so when we looked at the standardized approach, the formula was very simple. You have your exposure, you have your risk weight percentage based on the external rating, and that gave you the final value fairly easily. You only just simply map the external rating with the credit quality step, and you had your risk weight percentage. You multiplied, we got a risk weight, and then you got your capital requirement. But here it is a lot more complex. You have to compute your correlation factor R, you have to compute your maturity, and you have to compute the normal distribution. The good thing is you don't do it using an Excel spreadsheet. These are all done by the regulatory reporting engines. So the banks which have the permission to use IRB models, their IRB models feed into the regulatory reporting engines, and as a use of those engines, uh, the RWA is computed as a result of it. So K here is providing us the capital value. If we multiply K with 12.5%, we get the RWA percentage. If we multiply it with the EAD, we get the risk-weighted exposure amount as a result. Yeah. So at a high level, we see that under the capital requirement, we use this formula, which is specific by class. So we have a different formula for corporates and institutions. There will be a different formula for retails as well. Uh, Under the retail, the key difference is the maturity, which is defaulted at 1 year for the retail exposures. And then based on your regulatory reporting engine, you will be producing the output for your IRB model. And going back again, in order to use these IRB values, you always have to compare it against the standardized on a overall big picture basis, and that will determine your final risk-weighted exposure amount. All right. So the question is, what is the key difference between the foundation IRB and advanced IRB in terms of risk parameters? I'll give you a hint. The hint is on how many parameters can be modeled versus where you have to use the parameters provided by the regulations. If you could please attempt it and write your answer in the chat, that will be helpful. I'll give 30 more seconds, and
We have got
if
response
you
from
could.
Mr. Sheikh Mohammed. Basic
Mhm,
versus more advanced risk assessment. And Ms.
mhm.
Furkana has mentioned PD can be only determined by institution under FIRB.
Okay, thank you very much for your response. Let's quickly look at it. So yeah, I agree. PD is the only attribute which can be computed under Foundation IRB. Uh, with the name gives it all. Yeah, it's a foundation model. Under the foundation model, you can do less. Under the advanced model, you are allowed to do more. Under the foundation model, you can only compute PD, and LGD and EAD has to be used based on the rules itself. And under the advanced model, the model is complex. The risk management framework is more stable. The validation and monitoring controls are present and more stronger. Hence, the bank can recompute the PDs, LGD, and EAD. So all three attributes can be computed under the advanced model versus only one attribute which can be computed under the foundation IRB. So an example here is the institution exposures under under the rules which are currently enforced are under advanced IRB. So all three attributes are computed by the models. But going forward, only one attribute will be computed. So those institution exposures will move from advanced IRB to foundation IRB. So the model needs adjusting as a result. Okay. So if somebody was paying some attention, they should be able to answer this question. What is the minimum PD floor for corporate slash institution IRB exposures, and why are input floors necessary? So we did mention about the floors on this screen here. So Here we are providing the PD floors. We're providing the LGD floors here. Okay, so these floors are prescribed by the regulation, and under the mortgages, the floor is 5%, retail is 30%, unsecured corporate institutions, the PD floor is 0.05%. So just a recap of what we have. So the PD floor, can anyone answer now? We just gone through it again. So PD floor is 0.05%. So it is quite a low PD. The probability default is 0.05%, is very, very low, but it is there to ensure that the banks don't go with a zero probability of default. Okay. So this is, we have looked at the capital resources where we spoke about the uh, but capital resources can be held, common equity, Tier 1, and so on. And then we looked at the two types of credit risk capital requirements, which is the standardized and IRB. Now let's move on to the counterparty credit risk, which is applicable for derivatives and securities financing transactions. So it is more complex as opposed to your simple credit risk. Here we will try to answer the questions by using the 5W1H model. So what is the risk we are trying to address here? The risk is that the counterparty will default before the settlement of a transaction, leaving you exposed to the cost of replacing the instruments. Um, the Sakar approach, which is used in order to compute the there's a specific approach which is used in order to compute the counterparty credit risk for derivatives. It is called the standardized counterparty credit risk approach. And there's another approach which is called the model approach, which is the IMM approach rather. So the Sakar is more risk sensitive as opposed to the approaches which were used before. Sakar came into effect on 1st of January 2022 as part of the CRR2 implementation in the UK. And it has effectively all the system changes were required and new rules needed to be built for this one. It is used for the derivative exposures. Derivative has a bilateral fluctuate is a bilateral fluctuating exposure based on the market moves. So you have your market rates, FX spreads, and so on. Um, the examples of derivatives is interest rate swaps, FX forwards, and so on. The regulatory formula for the SACAR is your alpha into your replacement cost, which is RC plus potential future exposure. So using the standardized counterparty credit risk approach, you compute the exposure value for the derivative exposures. If you have repos on your book, repos and reverse repos, for those, there are different methods available. And the method we are looking at is the financial collateral comprehensive method in order to compute the counterparty credit risk for the repo transaction. An SFT has an exposure arising from the difference between the cash lent and the collateral received. So the way repo transaction work is you have you're exposed with you're given the cash, but you got a collateral against it. So and if there is a collateral haircut and is a mismatch in the currency, that will derive the FX as well as the collateral haircut that will effectively determine the exposure value. So so this slide will let's take away two things. There's a counterparty default element under the counterparty credit risk. There are two specific approaches for different type of products. For derivatives, it is standardized approach and counterparty credit risk. And for the repos, reverse repos, it is financial collateral comprehensive method, which is called the FCCM formula. So if we can take away this from this slide, then we can move on to the next one. The counterparty credit risk begins at the inception of the trade and it remains valid during the life of the trade. And Yeah, and this is and at the close of the trade, for example, if the counterparty had defaulted, the risk materializes at that stage. On default, the surviving party close out nets all trade in the netting set. If the MTM is positive, the loss equals that the amount minus any collateral held. So that is the replacement cost under the Sakar calculation. So this is just highlighting the timeline along which the risk is present. So here we are just highlighting the different type of products which this risk is applicable to. So using the 5Ws approach. So which products the risk is relevant to is interest rate swaps, FX, cross-currency swaps, equity derivatives, and so on. And we have the repos, reverse repos, security lending, borrowing, margin lending, and sell and buybacks. So all of these different type of transactions are covered under the counterparty credit risk area. Right. So now we go into a little bit more complex space. We look at the standardized approach on counterparty credit risk formula in a little bit more detail. Um, the benefit of standardized approach on counterparty credit risk is that it allows you to use the netting sets. The collaterals are considered. It is more mark to mark sensitive. Hedging is recognized. Yeah. So hence, this approach is more sensitive and more useful for risk management perspective as opposed to the previous standardized approach which was available. The formula is composed of alpha and RC plus PFE. Alpha is fixed, which is 1.4, is a regulatory scaling factor under Article 274. And the replacement cost and PFEs there are further requirements based on the type of the product, whether it is margined or unmargined. So for the unmargined, the replacement cost is maximum of current market value minus the net independent collateral amount. Net independent collateral amount is the amount of the collateral needs to be verified from an external system rather than taking the face value of it. So you can compute the unmargined replacement cost using this formula. But if it is margined, then the margin attributes will come into the formula as well. And then we'll have the maximum of current market value minus variation margin minus net independent collateral amount, or the threshold and margin threshold plus the minimum transfer amount or minus the net independent collateral amount or zero. So all of that formula will provide you the the replacement cost for the derivatives. Uh, Going back again, these values are not produced on UCs because obviously if you have a derivative book composed of thousands of transactions or millions in the case of large banks, then they can't be handled on a spreadsheet. It has to be done in a regulatory reporting engine. And the systems do produce these values, but they need to be validated obviously as part of the internal audit reviews and the model validation processes. You have your potential future exposure, which is the second attribute which you need in order to compute the exposure value for your counterparty credit risk. PFE captures possible increase in the exposure over the remaining trade life via a supervised add-on. So the current replacement cost is as of today, but if you see the future element, the derivative market value and other elements would move in the future in order to expose you to additional risk as well. So you have a multiplier and you have an aggregate add-on factor. The multiplier is computed using the formula which is available on the screen, and then you have to compute the add-on by all the different risk type, which is the interest rate, FX, credit, equity, and so on, depending upon the type of derivative which you are dealing with. If you have interest rate swap, then you use that one. If you have FX instruments, you have equity instruments, and so on. So depending upon the type of derivative, you compute the add-on for the relevant derivative, and then you compute the multiplier using this formula, and that provides you your potential future portfolio value. And we have the netting and collateral element as well within this one. So and that there are requirements for the unmargined and margined for this. And we've spoken about the multiplier. and the multiplier is 1.4. So you have computed your RC, you have done your PFE as well, but the regulators say that that might still not be enough. So whatever you have computed, you multiply it by 1.4. That adds a 40% buffer on what you have computed using your RC plus PFA. So this is a little bit in-depth view of the RC plus PFE and the alpha, which is used to compute the counterparty credit risk under the standardized approach. Okay. Now we move on to the financial collateral comprehensive method, which is used for security financing transactions. Um, these transactions are fairly simple. So you have a reverse repo in which you give a loan and you take a collateral against it. You have a repo in which you borrow the money and then you give collateral against it. Yeah. So, and then you have to compute the exposure for a counterparty, considering all the repos, reverse repo, and all the exposures which you have together on that. So the exposure in this case is maximum of uh, your exposure after the haircuts. For example, you have given a loan, so the loan value is exposure, and you need to take a haircut on that. And then you have received some collateral, and then you need to apply the haircuts on the collateral, and that provides you the collateral haircut value, which is the haircut on the market movements of the, say, if it is an equity taken as a collateral, the market price will move, and that's why there's a risk in that. And in order to cover that risk, there are specific haircuts provided by the rules, and you need to apply those haircuts in order to take the adjusted amount. So you don't take it on face value. 100 million is not 100 million. The market could move, and you need to put a haircut on it in order to take, say, 90 million as the collateral value against it. And then comes the FX haircut, because if there is a mismatch in the loan versus the collateral currency denomination, that would require a FX haircut as well. So considering the FX haircut and as well as the collateral value haircut, you compute this C amount here, and that provides you the overall exposure value for your repos in order to compute the RWS. So quick recap, your exposure is your loan given under the reverse repo. Your collateral is the equities, bonds, or any other instruments which you have received under the transaction. And then if there is a currency mismatch on the collateral, you need to apply the haircut on the in order to mitigate the FX element as well. So this is a little bit in-depth view of the financial collateral comprehensive method for repos. Okay. Um, Very simple question. What is the regulatory value of alpha in the Saka formula? So if you could provide the answer in chat, please, that would be helpful. So we saw an alpha is used for derivatives Saka computation. What is the value of alpha? It's a fixed value.
Ms. Furkana has mentioned 1.4.
Okay, anyone else want to give it a try, please? Okay, thank you much for your answer. This is correct. So alpha is 1.4. So this is a fixed attribute. So okay. Which regulatory approach applies to derivatives and SFTs for counterparty credit risk? So we just gone through the two approaches which we saw. One is for the derivatives, and for uh, there's a standardized one for derivatives. I won't give you the full name. And the second one is comprehensive one for the SFTs. If you could please recall, and if you could reply in the in the chat. And if you could maybe give a little bit more on the attributes which are used as well, that would be even more beneficial. I'm still waiting for a response, please. So what is the approach used for derivatives versus what is the approach used for uh, the repos reverse repos? Okay, we'll proceed. So the derivatives is a standardized approach on counterparty credit risk based on the alpha, replacement cost, and potential future exposure. And for the SFTs, we use the financial collateral comprehensive method, which is based on the exposure value after the haircuts and the collateral value after the haircuts. So it is fairly simple. But all of these are computed using the model. So it is the key thing is the input data which goes into it. The accuracy of input data will determine the accuracy of the output which is computed by the regulatory engine. Right. Okay, so before we move on to the operational risk, I would like to make a small case study on the screen. So you can see an Excel spreadsheet here. Yeah. Um, you see there are three cells which are in yellow. Uh, if you could kindly compute the common equity Tier 1 ratio, and capital ratio for 31st March and 31st December 24. Before I go into detail, this is example bank PLC. So all the values are made up. This is not real values. This is not a real bank. So everything is made up. So if you could compute, so we looked at the ratios earlier. We looked at the common equity one and so on. Yeah, and we saw how much the ratio should be and how much the ratios can be. Yeah, and how they are determined. So if you could compute these ratios and provide your answer in the chat for 2025 as well as 2024. So this is a small case study. Um, that would be very helpful. So I'm gonna take a 5 minutes break now, and after the 5 minutes, within the 5 minutes, if you could kindly do this, feel free to use AI, feel free to use your calculators or anything, and if you could provide the answers within those 5 minutes, that would be helpful. So I think rather it is 3:18 at the moment, so we'll come back at 3:23 UK time. Yeah. So I'll leave it on screen and we'll take a 5 minute. So see you after 5 minutes. Yeah.
Thank you.
Hi everyone, Bismillah, we're back. So let's hear.
So we are back from the break, and I can see one response from Mr. Sheikh Muhammad Mubashir. To 2025, 7.68 to 6.29, and then 5.02, 2024, 7.66 to 6.28 to 5. And then Mr. Arsalan has mentioned 2025, 13, 15.8, 19.9%. And 2024, 13, 15.9, 19.9%, same. And Miss Furkana, she's mentioned CET1, 13.0%, 13.1, Tier 1, 15.9%, and 15.9% for 2024. Capital ratio 19.9 and 20% accordingly.
Thank you very much. This is very helpful. So I think it's fairly straightforward to do these ratios as some of you have computed. So for the benefit of others, so we take the relevant attribute which we want the ratio for. So common equity table in this case, and we divide it by the risk-weighted asset, and that provides us the ratio. And for example, if we want to go with the tier one capital, we simply go with the tier one capital divided by risk-weighted assets. And then finally, if we were looking for the total capital, we pick up the total capital, we divide it by the total risk-weighted assets, and that provides us the ratios which we're looking for. So a very simple case study. Uh, Another view which I want to share with you is, so this table here is called KM1 table, and this is part of the pillar 3. So we've spoken about the pillar 1 until now, and then I thought maybe let's just give you a little bit of glimpse of pillar 3 as well. So these are set pillar 3 tables which are required to be published by the banks every quarter, every year. And then they are for a number of years. I've hidden the rows here at the moment. So, but anyway, this is an example bank only, so all the numbers are made up. So they, in this one, we set up, so this has specific requirements, like you explain first of all your capital resources, then you explain your risk-weighted assets, and then it provides the capital ratios as well. Then here is the element of pillar 2. So SHREP is the pillar 2 element, the supervisory review element. So hey, this number here is providing me that what is my capital requirement after pillar 2 consideration. So the capital requirement is 8% only, but if I take my buffers and other the pillar 2, then that requirement goes up to 15.5% for me. So it's not 8% anymore, it has risen up to 15.5%. But I can see my total capital which I hold is 19.9%, so I'm good against that. Yeah. And then here we are looking at the overall buffer requirements here. So here we see the capital conservation buffer, which is a fixed buffer 2.5%, the countercyclical buffer, and then the global systematically instituted buffers. And then if we put all the buffers together, it brings us to 3.92. And then we compare it against we add this one plus we add the buffers. This brings us to 19.42%, and we compare it against the total capital ratio. We are good against this one still, yeah. So here, this is 8% plus your pillar 2 risks, so risk for model, legal, and so on. And then you add all the buffers here, and then that gives you the overall requirement. And then you compare it against the total capital ratio. And then that is something, whether you are positive, you have to be positive in any case anyway. So that is one template called KM1 template. There's another template we can look quickly is the OV1 template. This provides us the risk-weighted exposure amount by classification, by approach which has been used. It shows us the RWAs and the capital. Again, all numbers are made up. Example bank. So here we can see under the credit risk, we are looking at the standardized approach, slotting approach, IRB, the three approaches we have taken. Counterparty credit risk, we think SACAR approach, IMM, and so on. And then we have the settlement risk underneath, market risk elements, operational risk, and then gives us the total risk weighted exposure amount. Okay, so these are mandatory templates. If you go to a search engine, if you just simply type any bank's name and along with the pillar 3 disclosures, it will take you to their investor relation page. There you can download the pillar 3 disclosures and you can understand how the risk management works for the banks, as well as looking at their ratios and how those attributes are working together. So that document provides massive amount of detail as well. So these are just two tables. There are large number of tables within that document. So here, this table is giving us the RWAs, and you can see this 218,500. So this number moves from this table into the KM1 table, and then this is used in order to compute the ratios here. So this is how those two tables are linking together as well. Okay, so this is a little bit of a case study with the values and everything, and these are the recomputations which you can do. All right. Going back to our deck. So we've got 30 minutes left to cover the operational risk, large exposures, and the model business impact of the capital. So from operational risk perspective, so the risk of loss resulting from inadequate or failed internal processes, people, system, or from external events. So all of us have heard about fat finger risks, where rather than typing 1 million, 9 million is typed, and the value became so big and it resulted into losses and so on. So these risks, they are actual loss events during the business, plus you have to compute the capital requirements against those risks as well. The different type of events can take place, which is internal fraud, external fraud, employment practice and safety, client, product and business practice, damage to physical assets, and so on. So these are the different type of risks which can occur. Under the reporting for common reporting, which is the correct reporting, there are templates which are for capital, as well as the templates which require you to report the actual losses which have occurred as well. So loss data is required to be maintained by the banks for a number of years. Okay. So operational risk, the risk is continuous. It crystallizes when the loss events materialize. And under the Basel 3.1 implementation, obviously, under the PS 1 by 26, there are three old approaches which have been removed now: the standardized approach, the model approach, and the basic indicator approach. And the new approach, standardized methodology, has been introduced now, which is binding for all banks. So banks were able to use models, banks were able to compute a lower operational risk. That benefit has been taken away now. And on an ongoing basis, a 10-year internal loss data needs to be retained for ICAP and Pillar 2 purposes. So we looked at the what and the when for the operational risk. Which and who is now. So old approaches have been removed. The new approach is applicable for everybody. So uh, there is no benefit available to smaller or bigger bank in now. The models are gone, and the interaction with the 72.4 is that obviously this is a standardized approach now. So there is no concern. Obviously, there is no model, so there is no comparison between model versus standardized approach for operational risk. Everyone needs to use the standardized approach in this case. Uh, there are two components of it. One is the business indicator component, and the second is the internal loss multiplier. Business indicator component is based on the financial metrics measuring income, fee, and trading activity. Uh, and then the ILM, internal loss multiplier, is taken at 1 for all UK firms, and then the loss data has to be available for 10 years for the internal capital adequacy assessment purposes and for the Pillar 2 assessment purposes. So this is a high level view of the which and the who for operational risk. The next element is how we compute the operational risk. Um, in order to compute the operational risk, the formula is the BIC, which is the business indicator component, and then the ILM, which is 1. ILM is kept 1 for a reason, to avoid the fluctuations in the market situation. So in some years, if you have more losses, ILM would have been worse than the others where you don't have losses. So in order to keep it consistent for now, the regulator thought or changed the ILM to 1 for now. Um Based on different type of incomes, interest, leases, and dividends, there are different buckets specified in order to compute the multiplier for that area. So interest, leases, and dividends, you have to compute your net interest income, and then or minimum of net interest income or 2.5% of interest earning assets plus dividend income. So that is a formula which is used to compute the IDLC element. Similarly, for SC and FC, which is the service component and financial component, there are specified formulas on the screen, which is your fee income, fee expenses, higher of the two, plus maximum of other operating income or other operating expenses. So these are prescribed formulas, and these are financial values which you use based on your financial statements, and then based on that, these values are computed. Um, the business indicator component, there are buckets as well, which introduces some complexity. So bucket one is that uh, if the business indicator component is less than 1 billion, you sit in under bucket one. If and that we get a multiplier of 12%. If you are in bucket two, then you have to take 120 million plus uh, business indicator minus 1 billion and multiply it with the 15%. So effectively, you will incur more charge if your BIC is higher. And if you are even bigger bank, then you go into bucket three, and then the formula becomes even more complex. So initially, you compute your BIC components, IDLC, SC, and FC, and that gives you your BIC amount, and then you compare it against the buckets where you fall, and then that derives your the operational risk computation. And the formula here is BIC multiplied by ILM, which is 1. That gives you BIC value, and then you compute your that is the capital. So in this one, we're computing the capital first rather than the RWA. So we reverse compute the RWA multiplying the capital value with the 12.5%. So we compute the capital first by this, and then we multiply it with the 12.5%, and that gives us the RWA value after that. Okay. So this is one of the three key capital areas like credit risk, market risk, and operational risk. These are the three key pillar one capital requirements which are in place. So again, this is to be computed by the regulatory reporting engine based on the data which flows from the financial statements. So there is a correlation or validation between the financial statement versus this one. A lot more correlation as opposed to which we see for the credit risk or derivatives and so on, because the numbers there are a lot more granular, which are used for the computation. But here, this will be the audited numbers which we'll be using based on the financial statements. Okay, so why this was introduced? So they took away the model, so it eliminated the model inconsistency. It is more simple and auditable using this formula rather than what you would have done based on the models. This is based on the financial statement data, so hence it is more reliable. So output for floor alignment already, because this is a standardized approach, so there is no comparison requirement anymore. ILM is set to 1 under the PRA policy decision in order to avoid pro-cyclicality and reduce the complexity. Um, but the loss data is still required to be maintained for 10 years. And then we have the risk-sensitive business indicator. BI captures income, fee, and trading P&L, a richer proxy for operational scale rather than simple gross income used in the BI ATS. So under the approach, basic indicator approach, which is currently applicable until for next 6 months, it is based on the gross income, but this one is considering your incomes, fees, and trading P&L. So here we have your interest, leases, and dividends, your service component, and financial component. So we're considering three components rather than just the gross income, which is under the under the VIA approach, which is applicable currently. So a lot more risk sensitive, but not model. So everybody will be in the same level playing field. So that's the why for the operational risk. All right. So we have a worked example on the screen for this one. So uh, we have the net interest income, uh, interest earning assets, dividend income, fee income, other operating income, and so on. So we have given all the attributes here, which are used in order to compute the different IDLCs, SC and FC. So using these attributes, you compute your IDLC, SC, and FC. Here it gives us the business indicator component of 2 billion. So at this point, we will compare it against the bucket. So if it was less than 1 billion, that would have fallen under bucket 1. But as it has gone above 1 billion, that's why it is under bucket 2. So in order to compute for bucket 2, we need to use 1 billion plus BI, which is under less than 0. So this is the, so effectively the bucket 2 is applicable because this amount is 2 billion, which is within this range, greater than 1 billion and less than 30 billion. And then we will compute the marginal BIC formula. So we'll pick up 120 million, which would have been done if it was up to 1 billion. Then we take the BI minus 1 million and multiply it with the 5%. So we pick up the BI, which is computed now. We take off the 1 million from 1 billion from this one. And then we multiply it with 15% and adding this 120 million. That gives us the BIC component as we are under the second bucket, and that provides us the 294 million BIC component. As the ILM is only one, so we take it ORC is effectively 294 multiplied by 1 is the same value. And in order to compute the RWAs, we simply multiply it with 1.5% and we get our RWAs. So in a simple way, we pick up the audited financial statements data. We compute our business indicator using the ILDC, SC, and FC components. And then we see the business indicator component, whether which bucket it sits into. And then based on the bucket, that amount is refined in order to add these additional computations. And that provides us the BIC value. If the buckets condition was not there, that would have been a value which is uh, uh, but with the use of buckets, we have to have a different value of 294 million in this case. So, and then the final element is computation of the operation risk computation amount, and then multiplying with the ILM, which is one with in order to reduce cyclicality. We get the operational risk capital requirement and we multiply it with the 12.5%, and that gives us the RWA. The reason being is when we look at our ratios are based on the RWAs, not based on the capital. So if we have computed the capital, we will always convert it back into RWA. So we can add it along with our RWA for credit risk and so on. And then we have, say, our RWA for operational risk here, and that RWA will add together, give us the total credit risk, total RWA for all risk types, which will effectively be used in order to compute the ratios. You can't compute the ratios based on capital. You have to have RWA based on in order to compute the ratios. Okay. And similarly, the RWA values are reported into a report which goes to the PRA called C02 return. That one does not have capital either. It just based on the RWAs. Very similar view to the first column of this one, which is purely based on the RWAs here. Yeah. So effectively, these values will be going into our C02 return, which is reported to the PRA on a quarterly basis. Okay. So that is the operation risk with our example. Okay, so going back to our Q&As, what is the SMA and what three methods did it replace under the Basel 3.1 approaches? Fairly simple. I think in the interest of time, I'll proceed anyway. So SMA is the mandatory operational risk capital method under Basel 3.1 effective from 1st January 27. And the three methods replaced are basic indicator approach, the standardized approach, and the AMA. What is the business indicator and why did the PRA set the internal loss multiplier to 1? Uh, Questions are slightly complicated. That's why I will answer it for you as well. BI is a financial statement metric comprising three components, which is IDLC, interest, lease, and dividend income, service, and the financial element as well. It measures the firm's operational scale more richly than gross income. And then PRA has set the ILM to 1 for now, but the loss data is required for 10 years as well. Okay, so effectively, these two questions are there to provide you a little bit of a revision at the end of this topic. Okay, large exposures. Large exposures is a very, very interesting concept, and here we will go back to uh, the legal entity identifier, which we spoke about before. You have to identify all exposures to one entity across all your systems. If you have exposure under the uh, lending, credit, or any say business cards as well, trading book exposures, all these exposures to one entity should be identified, and they, in order to identify it best, the legal entity identifier provides that comfort. And then entity should be correctly classified using the IC code. Uh, and then for the large exposure purposes, there are certain thresholds which are put in place by the regulator. So let's firstly discuss what is a large exposure. So an exposure is considered to be a large exposure for a bank if it is more than 10% of their tier 1 capital. So if any exposure is more than 10% of your tier 1 capital, that is considered as a large exposure for you. And the objective is to manage the concentration risk. So say if a company is very profitable and the bank thinks that I give all my money to that company and that will give me good profit, that is strictly prohibited because that increases a concentration risk. If that company goes bust, the bank goes bust straight away. So in order to limit the concentration risk to our company or a group of companies together, this large exposure regulations have been put in place. So we saw the definition of large exposure, and then there are certain thresholds as well. Uh, so there's a limit of 25% of T1 capital, that no exposure should exceed more than 25% of Tier 1 capital. So once it reaches 10%, you start identifying it and you start reporting it to the PRA as part of your quarterly reporting. But it should never go above 25% of your Tier 1 capital. If it happens, it's a breach and you have to bring it down, and you have to notify the PRA as well that certain counterparty exposure has increased that amount. For the globally systematic institutions, institution to institution, there is a tighter limit of 15% Tier 1. So it limits the risk of the global systematic institutions overall. So from concentration risk management perspective, the correct identification of counterparties and then reporting at 10% and making sure nothing goes above 25% is critical. In order to manage the 25%, banks usually set off the internal risk appetite limits, say at 23%, and then along with that, they will have their early warning indicators, say at 20%. That will make sure that the exposure never reaches the 25%. Why large exposure limits exist, we discussed it briefly as well. It is there to manage the concentration risk which the bank has. Otherwise, it can get into trouble, and we can get into a credit crisis if it happens across the industry. Okay. When it is to be considered, so before an exposure to a counterparty is incurred, that is to be assessed that the because this is considered at a counterparty level plus at a group of connected counterparty level. So you need to collect counterparties together. A counterparty and its subsidiaries are all seen together as a group. for this purpose. And the 25% limit is managed for the group together. And the 10% reporting is managed for the group together as well. Okay. So you have to make a pre-deal check to make sure that the exposure to the group is not more than 25%. And after the exposure is taken, that still does not go to that amount. And in an ideal world, it should not even touch your warning indicators. And after that, it is an ongoing monitoring, because obviously the exposures, if you have derivative exposures, due to the potential future exposure, the exposure can increase. And that's why there's a daily monitoring required as well. And we have a quarterly LE reporting to the PRA as well. And if a limit is breached, you have to notify immediately and you have to agree a plan to bring it below the limit. Um, so there are some changes which have been made as a result of the regulation, which will be applicable from 2027. The thing it works is this one reports your exposure. So if your exposures are changing as a result of Basel 3.1, credit risk, counterparty credit risk, and so on, they need to feed into this one. So all the revised exposures will then be feeding into this requirement of the large exposures. So this is where it comes into play. So, so you have all type of exposures in scope, on balance sheet exposures, off balance sheet exposures, derivatives, and repos. So all the different type of exposures need to be considered. Even the market risk exposures need to be considered in order to compute your large exposure limit. We need to look at the connected clients, and we need to look at the controller link as well as the economic dependency. So a counterparty who owns another counterparty, say more than 50% of the voting rights, becomes a connected counterparty for that. And then there's some economic dependency element, for example, major supplier, and there are other economic dependencies that also makes it a connected counterparty. Uh, and then those connected counterparty exposure needs to be managed together. There are some exemptions. For example, central governments are exempt from this one, and the qualifying central counterparties are also exempt for the limit purpose, because obviously if you're taking exposures which are listed exposures by a central counterparty, then that limit will definitely go up. So in order, and central counterparty is not exposed to this risk, so hence it is managed as an exemption. So there are conditional exemptions available for intragroup as well, and there are some reduced limits available for covered bonds and so on. Um The financial collaterals and the guarantees and so on also are applicable under this case. So you do apply your eligible credit risk mitigation for the exposures. So you have your on balance sheet, off balance sheet exposures, you take your credit risk mitigations, and then you consider your net exposure for the large exposure purposes. Okay, so this is applicable, the wholesale, all fund types, it is applicable to. Uh, Global systematic banks, there's a tighter limit of 15% rather than the 25% limit, which we see across, which is applicable for everybody else. Um, it is applicable to a single person, a single company, sovereign, and so on. And then it is applicable if you have a group of connected clients, it is applicable at the group level. And then there's a look-through approach available as well. Pillar 2 and SHREP, beyond Pillar 1 limits, the PRA expect firms to set internal LE limits below the regulatory maximum. So this is where we spoke about the early warning indicator and the risk appetite element. So 25% limit applicable across the board, everybody. Globally systematic important institutions, a lower threshold of 15% is applicable. So they need to limit their exposure at 15%. Exposures should be seen at the group of connected counterparty level. If there is no group, then the individual company should be is applicable for these rule purposes. And then you have to consider your internal limits as well, rather than just the 25% limit which PRI have provided. So under the different approaches which we have, so we consider your so FCCM for the repos and reverse repo. The SACA is applicable for the derivatives as opposed to the CEM method which was available before. Um, and then effectively it impacts all these approaches are more risk sensitive. So I think by using these approaches, you need to come up with a final value which is reported under the large exposure reporting. Okay. So we're looking at the two key regulatory thresholds. I would appreciate if you could mention the two thresholds which you spoke about. So one is when exposure is considered large exposure, and second is a limit beyond which an exposure should not be incurred. So if you could kindly answer those two. Thank you. Okay. We haven't heard from anyone, so we'll look at the output now. So it's fairly straightforward. So one is the 10% limit, which is the minimum, which is when an exposure becomes a large exposure. And second is the LE limit, which is the limit beyond which you should not go. So, and then there's a global institution limit of 15%. So this seems like very simple requirement, but it is really complex, and the banks across the industry uh, have to manage it using detailed systems. So every single exposure, every single transaction you take uh, impacts this concentration risk, which is monitored at 10% and managed below 25%. So from that perspective, this is a very, very key requirement. Okay. So I think on the measurement side, this is a little bit more complex. So I'll go in detail. So effectively, you're using the replacement method uh, the Saka method for derivatives, and for the financial comprehensive method for the repos and reverse repos. So all of those methods feed into the large exposure. So effectively, your computations which are happening as a result of Basel 3.1, all those exposures will feed into your large exposures, which you need to monitor. Okay, so the last thing which we want to look at is the business model impact. So Basel 3.1 regulations have brought in more risk sensitivity for the banks. Um, so in order to meet these requirements, banks have to change their models for the credit risk IRB approaches. They have to change the way they do their business as well, and then they have to comply the overall IRB output flow. So whatever is produced by the models, it will be limited by the output flow on overall. So as a result of new IRB output flow, we have seen changes in the standardized approach, counterparty credit risk, and the FRTB is being implemented for market risk from 1st January for standardized, and from 28 for the IMA. And the operational risk is a brand new approach uh, for the operational risk as well. So all of this is impacting how the banks will report the capital. From business perspective, there are some places where banks can gain. For example, under standardized approach, banks can use a lower risk weight of 20% if the loan to value ratio is 55%, less than 55%. So this gives bank incentive to encourage higher LTV lending, lower LTV lending rather, and get a lower risk weight. Um, and then there are certain type of products like trade finance and transaction banking, which are uh, they become more attractive. Securitization becomes more attractive, so bank can generate those loans, and they can uh, distribute those lending using the traditional securitization uh, to reduce the impact of RWAs directly, and then use the securitization RWA rates. Uh, well-rated corporate lending becomes attractive because you can apply the investment grade option. So the the thing I want to highlight here is that banks can change their business model and can adopt certain products, can focus on certain products which bring lower risk weights under this new regulations as opposed to the Basel III regulations, and that will bring the capital requirements down for the banks. There are some challenges which have come as a result of it. So uh, there are some businesses which are badly impacted as a result of Basel 3.1 because obviously it is more risk sensitive. Uh, it has there are certain models which are model options that are not available, like AIRB is not available for institutions, um, and then for large corporates as well. So all of these things impact the banks negatively, and it results into a higher RWA for the banks. So the banks need to update their models, apply for the foundation IRB models, in order to make sure uh, their capital is managed under the new regime. Okay, and then they can compliance the flow. So effectively, as been discussing, so by using a different product mix, securitization, RW rebalancing, the banks can effectively use strategies in order to implement Basel 3.1, but still have a fairly decent RWA, RWA under the new regime. Yeah. So we are 6 months away from the implementation of these regulations now. There will be FRTB IMA coming after 1 year of that. Uh, there will still be some output floor, I think different implementation by phase up to 2030. So from banking industry perspective, it is a challenge to implement it by the 1st January implementation date, and then to have all the systems and data ready in order to meet this compliance, and also change the business in a way that they can implement actions in order to minimize the impact of where the rules have changed adversely, or where they have become more risk sensitive, and gain on certain areas where the lower loan to value ratio, for example, is available, or for example, for the retail sector, there's a transactor class which allows for a 45% risk weight to be used rather than a higher risk weight which was available earlier. So there are some gains, there are some complications, there are lot of complications rather. But overall, this is a step in the right direction in order to build an approach of capital requirements which will be more risk sensitive, and it will create a level playing field for the banks. Um, and then I think and it will see a lot more consistent RWAs if the same exposures are used by different banks with the use of output flow. Um, I can see the topic was slightly difficult as opposed to the thing which we discussed before, but I really appreciate and thank the people for attending this training session, and for your contribution in the form of responses on the question and as well as on the case study. And yeah, really appreciate your contribution and your time. Thank you much. Yeah. Over to you, Karim.
Thank you very much, Vakar, for that insightful and practical presentation. I'm sure the members found this session and the whole series extremely valuable, particularly the clarity you provided on Basel 3.1 and practical implications of PRA. We will now move on to the question and answer session. Um, I know we have run out of time, but we will still take as much questions as we can. I encourage participants to post their questions in the chat box. We will try our best to address as many questions as possible. I've got few questions as well. Our first question would be, what is the main purpose of measuring counterparty credit risk for derivatives and securities financing transactions?
So both of these products are complex, and they are very, very volatile. So the derivatives value can go down and fairly quickly, and so you have a initial exposure in the form of your replacement cost, but the future impact can be very high based on the interest rate element or the FX element or the other element which you are exposed to. So hence we have a more risk sensitive PFE element, which brings the total amount. For the SFTs as well, we have a loan given in the form of a reverse repo. We have taken some collateral against it, which brings the net exposure to you. But that collateral obviously is based on equity or bonds or whatever. All of these are subject to volatility. So you need to adjust your collateral for your relevant haircuts for FX and for market volatility in order to compute that element. So those computations are very risk sensitive. They are addressing the type of risk which these instruments pose. So you need to address the future risk for derivatives, and you need to address the collateral volatility haircut for the collateral which you've taken on the repos and reverse repo. That yeah, so it is all about risk management. Yeah, thank you.
Thank you so much, Vakar, for such a detailed answer. There is a very simple question. I think we don't have the name of the participant, but is it applicable in Pakistan? His question is basically this.
Not at this stage, but for example, if you have if a bank has Pakistani exposures, but they are reporting on a consolidated basis in UK, then it is applicable. So yeah, so on a group basis, Pakistan exposures will be added as part of the group, and they will be subjected to all these treatments. But it will
Wonderful.
eventually, Pakistan will line up as well. Yeah, it will be applicable eventually. Yeah.
Sounds great. Thank you. And we have one question from Ms. Furkana. Uh, in business indicator, what is expense under service component, fee expense, or total expenses for the year?
As of the reporting period. So if you are doing it, so it is so if you're doing it for the year end, then we pick up the annual financial statements and then we take the values from there. So for the year end 31st December 25, you will go with the interest income expense for the year. So these are direct values from your financial statements.
Thank you so much. We have another question from Mr. Zishan. Under the large exposures framework, what is the maximum exposure a bank may have to have a single counterparty or a group of connected clients?
25% is the maximum limit of your tier 1. So every bank we have to look at its tier 1 capital. If one bank has a tier 1 capital 10 million, it will have to based on that. If one bank has a tier 1 capital 10 billion, then that changes as a 25% of that. Yeah. So it is dependent, it's a multiplier of your tier 1 capital rather than a numerical fixed value.
Thank you so much. Another question. What is the primary objective of an operational risk management framework?
Operational risk, everybody is exposed to operational risk. Yeah, so you have operational risk due to your system errors, you have fraud, all sort of elements they cause operational risk. Yeah, so as you are managing your credit risk, counterparty credit risk directly, and other risks like market risk, similarly you are exposed to operational risk and you have to set up a capital against it. So if you incur, say, a loss of 10 million during the year due to actual instances, and you have set up a capital of 12 million against it, then that is mitigated. But if you don't set up any capital against it, then it's a shock to the business. So that is a shock which is being absorbed by that capital.
Thank you so much. I think that's all for the question and answer section. Thank you, Wakar, for delivering such an engaging and insightful session. Your practical insights and clear explanation of PRA regulations and reporting requirements for banks have provided immense value to our members in this whole series. Additionally, your devotion and continued support towards the chapters initiative is highly appreciated, and we look forward to explore together further avenues for our members. I would also like to extend our sincere thanks to Mr. Yasir Gadid for his presence and valuable remarks. We look forward to your continued support for our overseas members and building our chapter together. And a special thanks to all participants for taking the time to join us and actively engage in today's webinar. On behalf of the UK Ireland chapter of ICAP members, we truly appreciate your continued support and participation in our professional learning initiatives. We look forward to welcoming you again at our future events and webinars. Until then, please stay safe, stay connected, and continue learning. Thank you, everyone. Assalamu alaikum, and have a wonderful day, evening ahead. Thank you.
Thank you. Allah Hafiz.